How's it going, everybody? My name is Aaron, and in this video I'm going to be going over how to find the net asset value, otherwise known as the replacement value or liquidation value of a business. To give you a little introduction about myself, I'm a recent graduate from the Richard Ivey School of Business. I've been trading for about 4 years with moderate success. I've done everything from day trading to swing trading and some longer term positions. And the point behind me making these videos is that I want to share what I've learned so far. I was recently lucky enough to study under a famous value investor within my program, and that really opened my eyes to why the mindset of a value investor is very attractive, especially for myself. And for that reason, I wanted to make these videos to share valuation methods and also how to find a business to invest in like a value investor. And so I'm going to be going over 4 valuation methods. The first one is going to be the net asset value, which will be the one I'm going over today. Next will be the earnings power value. And then we'll be looking at the value of growth. And finally, I'll be going over 1 and 2 stage discounted cash flow models. And from all of that, hopefully for you guys that are watching, you'll be able to pick which valuation methods you think are the most reliable or which ones you understand the best to be able to use moving on into the future. So I'm going to get started with the net asset value model right now. So the net asset value model is the most reliable valuation method, and the reason why is because it's valuing the company's balance sheet as it is today. So if the industry is viable, this model is going to generate the replacement value of a company's balance sheet. And the way that we achieve this is through transforming entries from accounting values to market values. And if the industry is not viable, it's going to generate the liquidation value of a company's balance sheet. But if you're going to be valuing a company that's in an industry that is not viable, you should have significant industry knowledge because the liquidation value of assets is very different from the replacement value. And the reason why is because the assets are not going to be generating returns at the same rate that they used to. So it takes somebody with significant industry knowledge to be able to value those assets. So for that reason, you should probably stay away from valuing companies and industries that are not viable. An example of this would be Blockbuster, who recently went out of business after Netflix came out and decimated the DVD rental industry. And if you had bought Blockbuster after they had a major decline in their stock price, you might have got into what's commonly known as a value trap, and that is buying assets that seem as if they're undervalued, but they're not going to be able to continue generating returns. So that is what's called a value trap and is going to lead to permanent loss of capital, which is something that value investors always look to avoid. So for that reason, you should always try to aim for companies that are operating in industries that are viable and generate the replacement value rather than the liquidation value. Now, the difference between the net asset value and the net worth of a company is that net asset value converts the balance sheet to market value, while the net worth uses the accounting value. And the reason why NAV, net asset value, is more accurate is because accounting rules can over or undervalue specific entries. And I'm going to be going over some of those specific entries throughout this video, and you'll see why the accounting value sometimes distorts what the true market value of an asset could be. So the first step in this model is you're going to need to find the weighted average cost of capital. So the required inputs are these 7 right here. The first one is going to be the average capital structure, which is going to be a 5 or a 10-year average, and you're going to be using the debt to value ratio, which I'll be going over, but I'm going to be using Disney as an example through this video. Next will be the marginal tax rate, which is equals the federal tax rate plus the state income tax rate. Next is the risk-free rate, which is a 10-year treasury yield. Fourth would be the bond risk premium, otherwise known as the corporate yield, and that's going to be assigned based on the credit rating of the company. Next would be the equity risk premium, and then the cost of debt, which is equal to the risk-free rate plus the bond risk premium, the cost of equity, which is the cost of debt plus the equity risk premium. And once you have all these variables, you're able to find the weighted average cost of capital, otherwise known as the WACC, using the equation down at the bottom. So to show you what this looks like, we're going to move on to Disney right now. So this is how I found the historical capital structure right here. I took the book values of debt and equity for each year, and I got all this data from their annual reports, which you can find on the SEC website or on their investor relations website. And what I did is I took debt and divided it by debt plus equity to find debt to value. And This gives us the average or the target capital structure, which is what the management has shown that they are aiming to have the capital structure at. So this is going to be the capital structure that we're going to assume the company will continue to operate with. Next, we have the marginal tax rate, which is 23.2%, which was 21%, which is the federal income tax rate, plus 2.2%, which was the state income tax rate. And I was able to get that from the income taxes portion of this. So right here, we're able to see that the income tax rate was 21%, and they actually list it down here. So we have 21% federal income tax rate plus 2.2% the state income tax. So next is the risk-free rate, which currently is 0.64%, and obviously that's very low historically. So if you want to raise the risk-free rate to match something that you're more comfortable with or that you believe is going to be the risk-free rate moving forward, then by all means you should change that. And next is going to be the bond rating, which I find based on a model that my professor created. So first you want to find the business risk. And to determine the business risk, you want to look at how volatile a company's earnings and revenues are compared to their asset base. So if they have a very large asset base and their operating profit or revenues are highly volatile, then that's going to tell you that during an economic downturn, that business is going to suffer. So companies that are with high business risk should be holding an optimal capital structure between 10 to 29% of debt to value. And the reason why is because a company who has very volatile earnings is not going to be able to meet their debt obligations during an economic downturn. So they need to have a lower debt to value ratio compared to a company who has low business risk, who can carry more debt. And an example of this would be a grocer, because everybody needs to buy food and that is very constant. So they're able to take on more debt in order to fuel their expansion or buy back shares, whatever it is that they're using that debt for. They're able to take on more because they have more stable earnings. When it comes to Disney, I chose medium business risk because their earnings are slightly volatile, and you can see that by looking here. During the 2007-2009 period, they took a 25% hit to their operating profit, and recently in 2019, they took a massive nosedive. So for that reason, I have them at medium business risk, which means that their financial risk should be somewhere between 30 to 49% debt to value, but since they have 27%, that means that their financial risk is low. And that would place them in a bond rating of AA to A, which has an implied equity risk premium of 4%. So that is where I got the remaining values. Here you see the 4% equity risk premium and the AA bond rating. And now to find the bond risk premium, otherwise known as a corporate spread, you just have to Google AA corporate spread and you'll be able to find that. And right now it's at 1.29%, which might be a little bit high. However, that's just what it is right now, and it kind of balances out the lower risk-free rate. So that comes out to a cost of debt of 1.93%, an equity risk premium of 4%, which leads to a cost of equity of 5.93% when you add the 1.3 and the 4. So after putting it into the WACC formula, you get a WACC of 4.7%. So now I'm just going to switch back to the PowerPoint to go over some more of the inputs for the model. So on the asset side, there are some accounting entries that are very quick calculations. For example, the cash and marketable securities, you can use a book value because they're highly liquid, so their book value mirrors their market value. Accounts receivable, you want to get the book value plus the allowance for doubtful accounts. And the reason why is because a company who's coming into this industry, if you're trying to replace this company, they're going to have that allowance as well. And you don't know if that allowance is accurate for the new company or not. Next is the inventories, and if it's using FIFO, you want to use the book value. If it's LIFO, then you want to find the adjustment for FIFO. And usually you can just divide by 0.95 if you can't find the adjustment, and that usually gets you to around the right value. Next, other current assets, because they're generally liquid, you can just use the book value. And long-term deferred tax assets, because the company is going to be benefiting from those deferred tax assets into the future, and you don't know the payment schedule, you're not able to accurately find the present value of those deferred tax assets, so you should just multiply them by 0.9 in order to get the closest approximation of what the present value of those deferred tax assets will be. Next, for the operating leases, you want to find the present value of lease payments, which I'm going to be going over on the Disney model. After that, excess real estate, you just want to find the after-tax market value of that real estate that they're selling. And goodwill is just going to be the book value, because now that companies are able to amortize their goodwill, they generally reflect the market value. However, if you think that goodwill is overstated, you should absolutely write down some of the goodwill, because goodwill is a tougher entry, and if you think that the company is overstating their goodwill, then you should absolutely strike it down. So now we're going to go into some of the entries that require adjustments, and the first one is going to be the property, plant, and equipment, and that's going to be including intangibles. So land, because historically land has grown at 3% a year, and companies list land at cost, the land is actually undervalued. So what you want to do is you want to compound the growth of land for 20 years at that 3% growth rate, so that you get an idea of what an accurate value of that land is today. Next, you want buildings. Are similar, except buildings usually are held for a little bit less, and for that reason you want to compound it only for 10 years using that same 3% growth rate. Next is going to be the construction in progress or leasehold improvements. Those are all going to be listed at cost. And then you're going to have other items in property, plant, and equipment, so furniture, fixtures, things like that. You're going to list them at cost times an adjustment variable, and that adjustment variable is going to be dependent on if that specific entry is high in innovation or low. So if it's high in innovation, something like software or technology, you're going to be using an adjustment variable of 0.5 to 0.7, because those assets are going to be replaced much more frequently, so you want to discount their value. And if innovation is low, so if it's something like furniture or machinery, you're going to discount at a higher variable, because those assets will stick around for a lot longer. So next, there's going to be some hidden assets. So the first hidden asset is going to be product portfolio. So if the company does R&D, some companies don't have to do any R&D. What you're going to do is you're going to take the 5-year average R&D divided by sales, multiply it by current sales, and then use a factor and multiply it by a factor. And that factor is going to be between 1 to 15, and it depends on how many years the R&D is useful for. So for example, Intel's R&D is only useful for 1 or maybe 2 years, because they have to come out with a new chip every year. So for that reason, you'd use a factor of 1 to 2 for Intel. Whereas a company like Kraft Heinz, their R&D has a long lifespan, so you can use a factor of 10 to 15. For example, like KD has been around for so long that their initial R&D is now spanned many years. So a factor between 10 to 15 would be used for a company like Kraft Heinz. Next, you're going to want to find the value of customer relations. And the reason why is because customer relations are integral to a company's success. And if a company were to replace another company, they would have to pay to build up the customer relations that this company has built up over the last X number of years. So what you want to do is you want to take the 5-year average of SG&A, which is selling, general, and administrative expenses, divided by sales, and divide that by 2. And the reason why is because a certain portion of that SG&A expense is going to be on attracting and retaining customers. So then you're going to multiply by the current sales, multiply by a factor, except this time the factor is going to be between 0 and 3. And so if the business is in a commodity industry, the customer relations isn't worth as much, because a buyer can go to another competitor and get the exact same product for the same quality. Whereas if the business is in a concentrated industry, so something like hardware for cell phones like Apple, there's only a few players, so the customer relations is very important. So you want to have a multiple between 2 and 3. And then if the business is in a differentiated industry, you're going to use a multiple of around 1 to 2. So moving on, the next one is going to be investment in advances, and that is unconsolidated ownership in a business. So that means that a company that you're valuing owns less than 50% of another business that they haven't consolidated in their income statement or balance sheets. So if the ownership is less than 20%, you want to use the cost method, which is just finding how much the company paid for that stake. And if the ownership is between 20 to just under 50%, you want to use the equity method, which is determining how much of that company's revenues and profits belong to you. And we're going to be going over all of this in the Disney example, so you can see how to do it for an actual company. So next is going to be the liabilities. Again, there's a lot of quick calculations. The short-term debt is going to be book value, accounts payable, and other current liabilities, all book value. The operating leases are going to be the same as the asset side, so they're going to cancel each other out on the liabilities and asset side. But again, it's a present value of lease payments. Deferred tax liabilities are going to do the same thing as deferred tax assets. If they're long-term, you're going to just multiply by 0.9 to discount the future payments. For preferred stock, you want to find the market value. And for minority interest, you're just going to be using the book value again. And so there's some required adjustments in liabilities. The first one is going to be to get the market value of long-term debt, and there's two methods to find that. So if you get the weighted average coupon on long-term debt, and this is near the cost of debt for the firm, then the long-term debt is equivalent to the coupon divided by the cost of debt times the book value of long-term debt. However, if the coupon, the weighted average coupon, doesn't approximate the cost of debt, you want to discount the future principal and interest payments by the cost of debt and sum that to find the market value of the long-term debt. Next is the employee stock options, which I'm going to show how you can find it. It's tough to find the market value of options. There's still a lot of debate in the industry as how to find the true market value of options. But this website is a good place to go to. It calculates it using the Black-Scholes model. And you input the variables into the calculator, and then it shoots out the market value of that option. Finally, you're going to have the pension plan. So if the pension plan is underfunded, then the company can expense funding the plan on their income statement, which means that they can take a tax loss on it. So therefore, you want to use the after-tax value if the pension plan is underfunded. However, if the pension plan is overfunded, the company won't be able to expense anything. So for that reason, you're going to use the book value if the pension plan is overfunded. So now let's take a look at Disney just to see what it's like to do it on an actual company. So this here in blue is the model. This is going to be giving you the intrinsic value of the company. So what it does is it sums this side to get the net asset reproduction value and sums the right side to get the net liability reproduction value. And the intrinsic value is just subtracting the liability reproduction value from the net asset reproduction value. And from there, you divide that by the number of shares outstanding to get the intrinsic value per share based on net asset value. So we can take a look here, and I'll show you where I got all these variables from. Everything I pull is from financial statements, so you're gonna have to get really comfortable to reading and looking at these. So here we go, the consolidated balance sheets. So the current assets, so the cash and marketable securities I just took from here. Same with receivables, except I added back the allowance which they had in the notes further down in the annual report. The inventories are used FIFO, so I used the book value. And then other current assets right here, I just summed these two remaining current assets. And next we're going to take a look at the capitalized operating leases. Now to find the capitalized operating leases, you have to find the section in the annual report that breaks down their payments, their future scheduled payments for their operating leases. Now for Disney, I got the first up until 2024. These were all listed, but then they have a section that says thereafter, and it lists a total payment of $2.4 billion. So what you have to do with that is you have to spread those payments out over 5 years, just so you can get a more accurate representation of what the present value of those payments is going to be. So then you have to find the present value by discounting them by the cost of debt. And once you get that, you sum those entries, and you get the value of your capitalized operating leases, which go right up here. So next we have property, plant, and equipment, which you'll see my adjustments down here. So I had land, so this is the multiplier when you take compounded 3% for 20 years. So I find the historical cost of all of these entries, and I apply my own multiplier to them. So for furniture and fixtures, usually I would use 0.9, but because Disney is always updating their theme parks and relying on new movies, their furniture and fixtures might be replaced more often, so I use 0.8 and so instead of 0.9. Land improvements, 1. Same with leasehold improvements. And then we have intangibles. You want to also include intangibles here, but you have to make sure to take out the intangibles that are included in hidden assets. So if there's any product portfolio or customer relations entries in their intangibles, you want to make sure to remove them so that you can put in your own values for them. So their character and franchise intangibles, I use 0.9 because a lot of their characters are intergenerational and they've been around for many years. So for that reason, I use 0.9. And then they had other intangibles that I listed at 0.8. So once you sum all of those values together, you get the PPE value right there. Goodwill, I just took from their balance sheet since they're amortizing their goodwill. Their goodwill is probably pretty accurate. Next, we have investments and advances. And now those I was able to find from right here. So the company actually presents their investments and advances in equity and cost value. So this is actually an accurate representation of the value of their I&A. But you want to make sure that the company does provide those calculations for you so you know that they're accurate. So next are the company's hidden assets, which are the product portfolio and customer relations. However, after going through the entire annual statement, I wasn't able to find any R&D figures, so I wasn't able to find the product portfolio for the company. But given the nature of their business, that's probably included in their intangibles section. And since the company doesn't list any R&D figures, it's best to just use the intangible figure as their product portfolio. However, moving on, we can calculate the customer relations aspect. So their customer relations, I took their SG&A expense divided by their revenues for 5 years, took that average, and I used a multiplier of 3 because Disney operates within an industry where the customer relations is crucial. So they generate demand by creating an intergenerational aspect to their business so that they can retain and attract new customers into their ecosystem consistently. And for this reason, they're not really competing with many other companies who operate in the same way. And they're also vertically integrated, which gives them a big advantage in being able to produce and distribute and deliver experiences to their customers. So for that reason, I used a multiplier of 3, which gave me a replacement value of $16.3 billion. And all of these entries are in millions. And then to get the other long-term assets, I just summed the remaining entries which haven't been included yet, which were the other assets and the film and television costs. And moving on to liabilities, I took the book value for these 3 entries here. Operating leases are the same from the asset side. Long-term debt. So for long-term debt, I took their payment schedule for long-term debt, and I included an interest payment, which they've been paying this year, which I just assume will continue on into the future. And I discounted that by the cost of debt. You can see that the market value is very similar to the book value of the long-term debt. It's just a little bit overstated on the balance sheet, but you'll see that it's often very close. So next, they had deferred tax liabilities, which you can see I multiplied by 0.9. They had redeemable and non-redeemable, non-controlling interest, but I included both of them in the minority interest there. And now for employee stock options, so this is where I have the employee stock options up here. So I'll just go over an easy example. I'll use the first item here, and I'll show you how to do it on the Black-Scholes calculator. So what you need, so here you go, actually it's already set up right there. So the stock asset price is 104. The option strike price is 39.7, which is from right here, and you can find all this in the annual report. The maturity is 2 years until it matures. Risk-free rate is around 1%. And volatility, if you don't know the volatility, you can just use 25% as a placeholder. So after that, you press calculate and you get the value of the European call. And you place the value of the option there. You have 3 million options outstanding, and you multiply the value per option by the options outstanding to get the total value. And I did this for all of their tranches of options. And when I summed them together, I got a total value of $857 million. And next I had the other long-term liabilities, which Disney actually broke down for me later on in this annual report. And in the other long-term liabilities section, which they have right here, in this $13.76 billion, they stated that $4.783 billion is actually their underfunded pension plan. So what I did is I broke those two apart, and I put I got the after-tax value of the underfunded pension plan, and then I included the rest in the other long-term liabilities section. So now that we have all the values inputted, we're able to find the intrinsic value per share Disney, which is $81.60. And the reason why that's so much lower than what the stock is trading at is because they have very strong earnings power. And that's something I'm going to be going over in the next video. So that ends it for this video. Thank you very much for watching if you've made it all the way through to the end. I have a Facebook group which I included down below, which I would love for you guys to join so we can start talking about any value investing ideas or concepts you have, and I can start answering any questions. If you also have any questions, you can throw them in the comments below. Please subscribe. I look forward to making some more videos for you guys, and I hope that this was helpful.